Well, hello everyone. Welcome to Getting Started with Options. My name is Barbara Armstrong. I am a coach with Schwab. Delighted that you have found the time to join me today for this class. So, what are we talking about today? Well, we're talking about a strategy that many investors might decide to pull out of their toolbox when a stock or when the market is pulling back. So this is a bearish to neutral strategy. It is called a short call vertical. Now, if you are brand new to all of this and you don't understand what I just said, don't worry about it. We're going to go over all of that. But I see a lot of the usual suspects in here today, who I affectionately call the people that have gone through this series multiple times. And so if you're brand new and it's a bit like drinking out of a fire hose, just recognize that that's okay, that you are in good company and that we're all linking arms here every Tuesday at, high noon Eastern and figuring this stuff out together. So I want to say good morning to Seattle Michelle and Hosier and Texas and Clicktician and Dawn and AP 514 and Chad and Jim and the rest of the gang. We also have Brett Crowther with us in the chat today. Brett is a fellow coach. He's a manager, and he is familiar with all of these strategies. And so if you have any questions, please do not hesitate to ask. And between Brett and I, hopefully we'll have answers with you. If you're watching this in the archives, as the majority of people do, you can ask your questions down in the comment section below. I do look at those on a very frequent basis, and so I'll get back to you pretty quickly. And the last way for me to be able to communicate with you and you with me is through the land of X, formerly known as Twitter. And I invite you to follow both Brett and I there. It's Brett Crowther CS for Charles Schwab and Barb Armstrong CS. So consider this your invitation. Let's get through some important information before we get to the heart of the matter today. First of all, know that options carry a high level of risk and aren't suitable for all investors. If you want to trade options with Schwab, you have to apply for option trading privileges, and not all will qualify. We have to take transaction fees into account, especially when we're looking at multiple leg option strategies, which a short call vertical is. I want you to be aware that we are using the paperMoney desktop software application, and it is a brilliant place to learn, to hone your trading strategies, to become familiar with how to place a trade and manage a trade on the thinkorswim platform. But there are a few nuances and differences. One is that a short option will never be assigned early, and a short vertical contains a short option. And if this is a bit of Greek to you, don't worry about it. We're going to explain it as we go. But that is something we don't get to practice in paperMoney that can happen in a live account. And we'll be looking primarily at charts today, but know that technical analysis, which is looking at charts, is not what Schwab recommends, nor I, as your sole means of making an investment decision. Okay, so this series, I actually created the series that I would have liked to attend when I started learning how to trade options back in 2011. As many of you know, I am a product of this education, found the education in 2011 and joined as a coach in 2016. So yes, so Riceberg is saying, one of the usual suspects checking in, so I'm glad that you're here. But in any event, over the course of 12 weeks, we go through 10 different trading strategies. And is the goal for you to be competent at the end of this 12 weeks in trading any particular strategy? No, it is not. It is to give you an overview of these strategies. And today, our focus is going to be on this short call vertical. But the idea is that over the course of 10 weeks, depending on your goals and your account size and how much time you want to spend looking at the markets and all of that, you might say, well, I have a large account and I really like the idea of these covered calls and these buy right covered calls and the short puts. And you might say, well, bully for you. I'm glad you like that, but I'm just starting out. I'm, 25 years old. I have a smaller account. And what really appeals to me is these long calls and puts, or these credit spreads and debit spreads where I can take a smaller amount of risk. Now, you might be approaching retirement and say, I know it may seem strange that I'm with the 25-year-old, but I'd like to be able to generate some income, and I can see these strategies helping me perhaps achieve that goal. But so it just depends on what you're looking for. But the idea is at the end of 12 weeks that you have a better grip on which strategies you might want to master first. And so the idea is not to try and master, all 10 right out of the gate. And then we have going forward classes specifically designed just to focus on, for example, short verticals. And that class is starting in July. It's going to be taught on Thursdays at 1:00. And yours truly, I'm going to be adopting that class. There's another class taught on Thursday mornings by Ben Watson that is just dedicated to long verticals and something called diagonals. There's another class taught by Mike Fairborn on Mondays that just focuses on these three strategies. And so, and then there's another class dedicated to long options, also taught on Thursdays by Connie Hill. Okay, so there are places you can go to develop more expertise. So today, what's on the menu? Yeah, and somebody's saying, that's me. I'm loving learning about the verticals. And for me, these were the strategies that I first embraced also. But, that isn't to say that that's where, you might want to focus. But so we're going to look at these short call verticals. Sorry, let me go back for a sec. What they are and why someone might be interested in trading those. And then we're going to look at some of the basics. We're going to go and place an example trade and then discuss, once we place a trade, how we might choose to manage it and when we might choose to exit. Now, before we start, one of the things I will say is that this is a bearish to neutral strategy. And right now, the markets are really strong. So you might say, like, Barb, why are we even talking about this today when the markets are close to all-time highs? And it's, do you really want to wait until you need a strategy to figure out that it might serve you? And last week, we talked about what I call the companion strategy to this, the short put verticals. So the reality is, if we were actually looking to place trades in today's market, this might not be the strategy we would first go to. But we want to have an understanding of what it is and what it can do for us so that when we do need it, like back 3 years ago, we used this strategy really frequently. And it worked really well for us in the year when the S&P was down 18% and the NASDAQ was down 30. This year, more limited use. But having said that, let's go on. Now, was this a mistake? Actually not, because being a visual learner myself, I find it easiest to draw something out and then kind of look at the verbiage around it. And so if we have a stock that has been on the struggle bus, and there have been many actually there, this year, in spite of the fact that the markets are moving up. So if we have a stock and we see it fall and then it tries to rally and then it falls again and then it tries to rally and then it looks like it's going to fall again, you might say, hey, this might be a stock where I could use that short call vertical strategy. And what are we going to do? Well, what we're looking at is selling a call. So we're going to come up above where it's currently trading and sell a call. And so let's say it's trading at $48. So we're going to sell the 50 call. And let's say we get paid $2 to sell that call. Well, what does it even mean to sell a call? Well, when I sell a call, I'm agreeing to sell you shares, 100 shares, of this stock at $50 a share if you'd like to buy it from me. But I don't have any shares. I don't own this stock. And so what my expectation is I'm expecting that the stock is going to continue to fall. Okay. But what if I'm wrong? Like highly unlikely, but like it is possible. No, I'm just kidding. Like, what if I'm wrong? And sometimes these things happen. And what if it goes up? Like, what if it goes up like to $60 a share? Like there's some news of a merger that comes out or something. Well, I now am obligated, and the higher it goes, the higher the likelihood that I might be what they call called out. And this is what I was talking about earlier, where we don't get to practice this in paper money because you'll never be called out early. But when I sell a call, I could be asked to sell 100 shares of this stock at $50. And if I don't own the stock, what would I have to do? I'd have to go out and buy it at 60 to sell it at 50. And you know, all I can say about that is like, oh no, like that would suck. And that would be pretty expensive because I'd have to pay $10 more a share, right, for the stock. And I only got paid $2 to sell the call. So I'd be down by, you know, by $8 a share because I'm paying $10 more. So how do I prevent that from happening? Well, what I do is I come out here and I buy a call. Okay, so what am I getting myself into when I buy a call? Well, when I buy a call, I have the right to buy the stock. And let's say I do this at 52. And let's say I pay, say, $1.50 for that. Well, now the net gain that I have, or the net credit, is 50 cents a share or $50 a contract. And so now, even if it goes up to 60, I have the right to buy the shares at 52. So if I'm called out at 50, I can go buy the shares at 52, meet my obligations, sell the shares, and now I'm not out by $10 a share. I'm out by $1.50. So my potential return on, so how much am I risking? I'm risking $1.50 a share. And how much can I make? The most I can make is what I got paid to get into the trade, which is 50. And so my return on risk is, in this example, is about 33%. So I'm risking 3 for the opportunity to potentially make 1. And you might say, well, I don't really like those odds. Well, you may not, but depending on where you put your strike, where can I find the archives? Yeah, so Brett will post a link to the archives for these option basics, but I will show you also. It looks like I may have just taken a short commercial break. Am I back? The guys are saying glitch in the, okay, I'm back. Okay, so there we go. So I'm wiping the board clear, and now let's go through and walk through some of the points that are pretty well made here. So, you know, what is a short call vertical? So we are creating an obligation by selling a call. Okay, so we're going to sell a call, and we know that we can be called out at any time up until expiration from the time we place the trade. And then to manage the potential damage, we are going to then buy a call. And that gives us the right to buy the stock at the strike at any time up until expiration. So there's we're selling the 50, and in this example, buying the 52. Now, another time when we might be interested in trading this is if something's going sideways. So if the stock was trading like this, when it rolls over, we might say, hey, here's another chance for us to use this strategy. And we're calling that a short call vertical. Now, some people will call this a bear call spread. Other people might call this a credit spread. Now, don't shoot the messenger. I'm not the one that came up with all these names, but they call it a credit spread because we're getting paid when we enter the trade. okay? And we're creating that credit because the call that we're selling is more expensive than the call that we're buying. And so we end up with a net credit. And we are bearish, and bearish means that we believe that the stock is going to go down in value. Okay? Yeah. Now, so I'm a big believer in having a recipe or a trading plan. The first time I make something, if I'm cooking, I like to have a recipe as a guideline. And when I'm trading, I actually used to make up sheets like with a checklist, and what was on the checklist? Well, there are 4 components, and it's what to trade, when to trade, how much to trade, and when to exit the position. So 4 components. And this is looking at the first component. This is the, what to trade. Okay, so if we're looking at what to trade, here's our what to trade. We're looking for a stock that is bearish or downtrending. Sorry, what to trade. So we're looking for stocks that are moving down or going sideways. We're looking for stocks that have higher trading volumes. And, why do we care about that? Because this is an options class, isn't it? Yeah, it is. But if a stock has higher trading volumes, and by that we may, I've seen James run queries, James Boyd, another coach, where he wants it to trade 5 million shares a day or more. You might say, well, for me, high trading volume would be 1 million shares a day or more. And most stocks listed on, say, the NASDAQ or the Dow, the NASDAQ 100, or maybe the S&P 100 might fit that bill. We're looking for options also that have high trading volumes. And that's expressed as open interest, which is the number of contracts that were on the books when the market opened today. And volume is the number of contracts traded today. And there is a different number for every strike, for every expiration date, for every stock. And we also, and then some traders might not even have those columns up on their chart. They just want to see that the bid-ask spread is tight. And by tight, they might say less than 10%. This is the amount that the market maker makes. And for volumes, you might say, I want at least 20 times the number of contracts that I'm going to trade. So if you're looking at doing 5 contracts, then you might say, well, I want there to be at least 100 contracts, between the volume and the open interest. I mean, this is your trading plan. You can make it whatever you want. These are just some ideas. And so if we're looking for these as options, let's go out. Okay, and then the second thing we want to look for is an entry signal. So there's the what to trade, and then the second piece is when to trade it. So this is in our, when to trade component of an example trading plan. And in the trade management mini sessions, I have an example trading plan for the short put verticals, which is the companion strategy to this. So it's kind of, you're going to do the inverse in that instead of, you want to find something that is breaking below support. So if we had something that was trading in a sideways range like this, we might look for something that's coming down and then breaking through this support level. We call this support or the floor, and this resistance or the ceiling. Or you might look for something that is pulling back from resistance. So you might want to consider placing a trade here when it bounces down. And then you might want to close it out when it gets here. Or you may want to place a trade when it breaks down here. Okay, so this is if something's sideways. And we're looking for, some people call this a kablode, which is a close below the low of the high day. And then the other, with this line that I was drawing before, this is called a bear flag. So here's the flagpole, and here's the flag. Flagpole, flag. And we're looking for an entry where, it's tried to rally, and then we're looking for the next day or in the next couple of days for that candle or that stock to trade and close below the low of the high day. Okay? You guys are keeping keeping Brett really busy, and that's awesome. So let's go out and see if we can find something that meets these requirements, and then we'll look at the next two components. Okay. Yeah, and I don't talk a lot about gamma in this class. This is an introductory level class. And gamma measures the rate of change of delta as the stock price moves. But that's a little beyond what we cover in this class. Now, we may talk about that more. You may, bring that up more in a class dedicated to a topic like short call verticals or long call verticals. So we're going to come out and we're going to look at a chart. And the first chart we're going to bring up today is CRM. So when we look at CRM, first, when we look at how it's doing year to date, it's down 8.5% year to date. And the S&P and the NASDAQ and all the indexes are up, but this one is not playing along with the rest of the gang. And when we saw the last earnings, it plummeted. Humpty Dumpty, he was sitting beside Humpty Dumpty and they both fell. And it's tried to rally, but it came up to about this 245 mark, and then it fell again. And then it came up again and hit 245. And so it would appear, looking at the chart, that some might say, well, this seems to be now acting as a bit of a ceiling, this 245. And so could we perhaps come out and sell a call above 245, maybe at 245 or maybe at 250? Maybe could we sell the 250 call? And then could we, to limit our risk, because otherwise, if we sell a call and we don't own the stock, how much risk do we have? Unlimited, because there's no telling how high it could go. If it gapped down, it could gap up. So we're going to buy a call. And maybe with this one, it's a more expensive stock. Maybe we buy the 255. And would there be enough premium in there, for it to be worth our while? So let's go and look. Okay. So this time I'll erase. So we're going to come to the trade tab. And one of the questions I got asked in the comment section today was, I'm having trouble making my columns look like your columns. And you can customize and then save a layout if you like. So with this one, first of all, we're looking for a stock that trades more than 1 million shares a day. So does this stock trade more than 1 million shares a day? So for that, we would come up here and say, okay, yes, it's at 1.9 million and we're still early in the day. And then we wanted to come and look at maybe this 250 strike. And so when I come over here to open interest, remember open interest is the number of contracts that were on the books when the market opened today, 7,000. Well, how many contracts are we going to trade? If we're looking at this smaller account, we're probably not going to trade more than 2, maybe only 1. So, I mean, we've got lots of volume there, 272 contracts traded today. And then when we look at the bid-ask spread, is it less than 10%? So as a rule of thumb, I look at this 21, is it less than 21 cents apart? Well, it's about 12, 13 cents apart. So check. So check, check, check. Now, the next question is, are we looking at a reasonable time frame? And often we'll look for something 20 to 50 days out. Now, if you go 20 days out, and this is 24, likely we'll receive less premium, but the time decay will move faster. And that's what we want to have happen, because we want to sell something and have it decline in value, which is kind of counterintuitive, isn't it? Because we're used to the idea of when we first start investing, we buy a stock and we want it to go up in value. This idea, we're selling something and we want it to go down. And then delta, which is right here, often people, as a rule of thumb, will look for delta that's somewhere between the 20 and the 40 range. Now, the closer you are to 20, now you can see here, and let me just wipe my slate clean and we'll start again. I've added these two columns, probability of in the money and probability of touching. And when we come and we look at this 250, we have a 25% probability of this being in the money at expiration, which means we've got a 75% chance of it expiring worthless. But we've got a 50% probability of it at least coming up and kissing that price, is how I like to say it, of at least touching it. So if it comes up and hits 250, are we going to panic? We are not. Because we know that there's about a 50-50 chance of that happening. So let's go out and see if there's enough premium for this to be worth our while. So we're going to come out to this 250. We can just right click anywhere on this line, and we are looking to sell a vertical. Okay, so when we sell this, it's automatically going to pick the closest strike to it to buy as a default. So in this case, we're looking to sell the 250, and then to manage the potential damage, we're going to buy the 252. So Michael is asking, why not do the 260? Like, wouldn't that be safer? And yes, it would. Well, let's go look at that. Now, one of the requirements, if you have an example trading plan, you might say, well, if I'm going to be in this for 24 days, and you can see the number in brackets here represents the number of days to expiration, the 100 represents the number of contracts, the number of shares in each contract. So our rule of thumb, and I'm going to change this to a calculator, is that if I could make 56 cents, how much am I risking? I'm risking 250 minus 56. So I'm risking $1.94 for the opportunity to make 56 cents. So if I take 56 and I divide it by $1.94, my potential return on risk is 28.86%. So let's round that to 29. And what we want is that number to be higher than this number. That's our guideline. And it's a way of taking something and trying to make it more apples to apples. And to say, like, well, why not go out to August? Well, then I'm going to be in it for 50 days. And so then I'd want at least a 52% return on my risk. But often when we come out more than double the time, we don't necessarily get double the premium. And also, like, if I look and come out to August, these are $10 wide, these spreads. And if you have a small account, that may be too much risk. Okay, so let's look at why not do the 260. So if we did 260, the probability, and I'm going to come back to this time frame, the probability drops to 11%. Well, like, that means, yeah, we have only a 9% chance of this being in the money. So that means we have a 90% chance of this trade being profitable. But how much could we make? 18 cents, and I'm risking 250. So if I look at this and I say, well, okay, I can make $18 a contract, and then how much risk am I taking? I'm taking $2.32 worth of risk for the opportunity. That's only a 7.7, call it an 8% return. That doesn't meet our requirement. We're not getting enough premium for us to be able to take that risk. So back to the drawing board. So we're going to go back to the 250. It meets our requirements. We have a relatively high probability of success, 75%. And how much are we risking? We're risking just shy of $200. In this account, we're willing to risk up to $500. So we're going to sell 2 of these. And it's summertime. So, that means vacation. Maybe you're golfing. Maybe you live on a lake and you're out on your boat and you don't want to be stuck to your monitor all day looking at the stock market. So you might say, I am going to put in an order and I'm going to look at this every day. But just in case this pops up or pops down dramatically, because this is a bearish order, I'm going to create an opposite order and say, hey, when this is worth about 10 cents, I've got about 80% of my max gain out of it. I would like to buy it back and take my risk off the table, because what the market giveth, the market can taketh away. Yeah. So we're going to come out here. When we come to confirm and send, we want to sell 2 verticals, 2 call verticals. That means we're bearish or at least bearish to neutral on this stock. And we're going to put it in our short call vertical bucket. Okay. And how much could we lose? $394. How much could we make? 106. And are we looking for a grand slam with a trade like this? No. We're looking for a base hit. But if we look at this and say, hey, if we could make like $90 on this, $85, that's a base hit. And if we could do 1 or 2 of those a week, maybe we could generate, $500 a week in income that we could then put into take the grandkids to Disney, pay off my college, put towards my college debt, buy groceries, like whatever it is. I mean, that's what we're looking at. Okay. So this is a higher probability, lower return. So we're going to do another example, Lee. Okay, so JW brings up a good point. So let's just pause for a sec and go back out to CRM. And so if you want to show this on your chart, I'm going to take this line and I'm going to make it 250 because that's where our strikes are. So 250, and we have a short call vertical at 250 and 255. And it's going to expire July 19th. So if I'm going to look at this daily to just see how we're doing, I can, when I bring up my chart, just see. And as soon as I look at this, I know that what this means is that I want this stock to stay below, or my expectation is it's going to stay below 250. So if, and I'm going to draw another line here. 255. I don't want to make this. If this stock comes up in the meantime, and this is this is the strike that we bought, the 255. So what if it comes up, and just let me get my drawing tool. All of a sudden, some kind of news comes up and it comes up here and it's now above 250. Remember, I said we don't get to practice short calls being assigned in paperMoney, and that's true, we don't. Could you be assigned in your live account? You could, but just because it goes above 250 doesn't mean you're automatically going to be assigned. Yeah, actually the strikes are, you're right, 250 and 250, 250. Let's just leave it at 255. So but let's say it was in between the strikes and you were assigned, and the stock is now sitting at 251. Well, this is a small account. Like 25, we don't even have $25,000 in cash, you know, to be able to go out and buy, let alone 25,100 to be able to go out and buy if the stock's trading at this price. But if we've been assigned, what we can do is immediately go out and buy 100 shares to meet that obligation, and then, you know, they'll be sold and we'll be back in an okay spot in our account. Now, if some news comes out and it gaps up, the higher it goes, the higher the likelihood that we could be called out. And if it's gone through both strikes, what we might do then is say, okay, I'm going to exercise my right to buy the shares to then fulfill my obligation to sell them at this 250. And now I've incurred my max loss, but I haven't blown up my account because I didn't sell on naked call. Okay. So I hope that answers your question. And our strikes, this one is actually at 250. But if you end up in a position where you know, are underwater and this number is negative, you can expect that you're going to have somebody reaching out to you and saying, hey, Barb, you need to put more money in this account. And if you don't have more money to put in, this is, you would exercise this and then sell it. And because those two things will happen very quickly together, then you're fine. But why do we want to close this trade no matter what prior to expiration? Because our theoretical max loss, if this closes above 250 on expiration, it will be exercised automatically. Entirely likely that that will happen. And so the probability is very, very high. But if this happens at expiration and you let this expire, then you don't have the right, you know, to buy this, you know, at 250. So that's when you can get into trouble. And then what if news came out and it gapped up on Monday after it expired, you know, on Friday, and now you have to go out and buy it at 260. So you can end up, you know, in a pickle. But if you close it out prior to expiration, then you keep your options open. Okay. Okay. So let me wipe that. Let's go and look at one other example, because somebody wanted to see how I did that opposite order thing. So we're going to look at Intel. So Intel is another one that's been on the struggle bus. It's down almost 40% year to date, which is making CRM look not so bad. It was kind of going sideways, then it started to fall. Earnings came and, you know, it was sitting there with Humpty Dumpty, had a great fall. And once again, you know, when we look at this, and, you know, again, I like to draw things out on the chart. So it started when it gapped down, it came down to here. And it came up in the neighborhood again, came right up and kissed it here. And it's been kind of moseying along, going sideways. But could we maybe sell a 32? So sell a call around this 32 mark. Oh, sorry, I thought I'd change that. So sell a 32. And because this is so much less expensive a stock, maybe we buy the 33. At 32 and 33. And kind of like CRM, we sold the 250 and it was trading below that. So it's trading at 30.69. So we've got $1.30 worth of wiggle room, so to speak. So if it goes up a little bit, we're okay. If it continues to go sideways, you know, we're still happy campers. And if it goes down, well, we're more likely to reach our max gain even faster. Now, we want to be out of this prior to earnings. So this is where you'll want to click on this and say, hey, when is earnings coming? And that's July 25th. So if we look at this July 19th and we came up to the 32, we've got 21,000 contracts. It's traded 12 million shares. So we've got lots. Was it 32? Okay, so we're looking to sell a vertical. And it, like I said, it will automatically default to the smallest possible. So this is 23. So it was 25 when I looked at it earlier. So but 23 divided by 77, that's almost if I round, that's 30, a 30% return on risk for a trade that we would be in for 24 days. So that would meet our requirements. Okay. So I'm not going to put in an OCO order, but if you want to come to the short put vertical class, we can look at that in another class. And the reason we don't do that is because, again, when we look at this probability, it's got a 60% probability of coming up and touching it. But some might say, hey, if this gets to the point where it's worth 75 cents, I'm obviously down on this trade and I would like to exit. And so you can do that. But if we just come in, I'm coming to advanced order, first trigger sequence. I'm going to right click, create an opposite order and say, hey, when this is worth about 5 cents, I'd like to buy it back. And how many of these could we do? Well, we could do 5 of these. And 1, 2, 2, 3, 4, 5. When I come to confirm and send, I'm going to make this good till cancel. Confirm and send. So I'm risking $380. Is that less than 500? Yes. For the opportunity to make 120. Now, I might say, well, if I can risk 500, I could do one more. So I can come out here, make that 6, 6. So now I'm risking 462. Now my transaction fees are $7.80. The most I can make on this is 138, and I'm saying, hey, if I make 100, we're happy, because we're going to buy it back for a nickel. So that would cost us 30. Well, 5 times 6 is 30. So that would leave us 108 base hit. So we're going to come down and put this in our short put vertical group and fire in the hole. How much could we lose? 462. Okay, now again, like I said, the market is hitting, is within a couple of days of having hit all-time highs. And some might call this a bull flag type pattern setting up. And so this might not be a strategy that you would be looking to use today, but there might be some time in the future when this might be your favorite strategy to use. And then you might decide to never use it, it's totally up to you. But let's go out and wrap things up because we are rapidly running out of time. So just as a review, the short strike, the strike we're selling is usually above a resistance level, or if we can swing it above 2 resistance levels. And we're looking for a delta between, this says 30 and 40, some might say 20 and 40. Again, if this is part of your trading plan, you make up what you want. And then we're buying a strike above the short strike, which gives us protection, but it ends up with a credit. And we're looking for something in that 20 to 50 days, an expiration date that falls within that range. Our return on risk, some have a target. Our example target was if we're in it for 25 days, we wanted at least a 25% return on risk. Some traders will position size based on max loss. It's just a more conservative approach. Others might have a different way of position sizing. And our outlook is bearish or sideways. And again, our max gain is less than our max loss. And one of the disadvantages is that, one max loss can wipe out several max gains, right? So and this is theoretical, and it's based on being out prior to expiration. And we want to be aware of things coming up like earnings, and some will have that as part of their rules, that they do not want to trade this over earnings, because if it gaps in the wrong direction for them, then they've got a max loss. And when volatility is higher, premiums are higher. So some might consider this to be a more appealing strategy when volatility is higher. So again, we want to take transaction fees into account. We know that if we don't exit prior to expiration, there are additional risks. We know in a live account, short options can be assigned at any time. And our max risk is the difference between the strikes minus the credit. What are the benefits? Well, some might say a benefit is that it can be looked at, depending on where your strikes are, as a higher probability trade. We can look at it as a way to either grow the account or generate income, but our gains, they're limited to the credit received, but we know how much we can potentially make going in. And this is a shorter or an intermediate term time frame, 20 to 50 days. Okay. And then we've already covered our risks. Alrighty. So guys, I think that's a wrap. We've covered a lot, and if your ears feel like they're starting to bleed, just know that you are not alone. If you're new to this strategy, it takes a hot minute. And when do you want to consider? Prior to expiration, no matter where you are. And then, you might say, hey, if I had 50% tomorrow, if this stock gapped down, I might say, hey, I made 50% in one day. I'm good with that. And you could choose to exit. Or you might say, hey, if I get to the point where I'm under 100%, I want to exit. Or if it breaks a resistance level and it looks like it's no longer going to continue downtrending, you may want to exit then. So guys, we've covered what we set out to cover. Thank you so much for joining us today. Please hit the like button, subscribe to the channel. Don't forget to follow us in the land of X, and I will see you in the webcast coming up soon. Bye for now.